So this is Chapter 10, Commercial Properties, in the Principle of Appraisal. So the commercial properties can include apartment buildings, industrial buildings, office buildings, retail buildings, including plazas and shopping centers, or building that mix offices with retail and mix with retail with residential component, which is more like a mixed use. So one of the challenges in valuing commercial property relates to the amount and type of information that is required to be collected. And so in addition to being able to use direct comparison approach and the cost approach, the income approach can also be used. Now, which approach we finally end up using will of course depend on the type of the commercial properties. There are some type of special purpose or single purpose industrial properties which can only be valued by cost approach, given that it is very unlikely that you will find a comparable which was rented, because those are like single purpose industrial properties. And also there is no lease or rental information, so that's the reason we cannot use income approach. The challenge with the income approach is that the appraiser needs to reconstruct the income and expenses of both the subject property and the comparable used to evaluate capitalization rate. So it's very tricky to get the cap rate, and any small amount of difference in the cap rate has a multiplying factor on the actual valuation. So, it's important that we do the reconstruction of the income and expenses between the property very carefully. Um, so with this, we can dive into the details. So the first information critical here is collecting the and analyzing the information for the commercial properties. The collection and analysis of information for commercial properties follows the same process as it does for single family homes and condominium units, as information is needed on the neighborhood site improvements in order to be able to arrive at the value. The type of information that needs to be collected and analyzed will of course depend on the property being appraised. So in the case of apartment buildings, access to the public transportation, proximity to education facilities such as school, colleges and universities, distance to shopping, proximity to of recreation facilities such as a park, golf courses, theater, skating rinks, stadium, swimming pools, proximity to medical services, level of security in the neighborhood and the building, parking above the ground or underground, laundry facilities, amenities in the building such as a pool or exercise room. These are the couple of information that is required to be able to assess the apartment building. Now, in case of office buildings, we need the proximity of to shopping, restaurant, health club, distance to public transportation, frequency of public transportation services, availability of office services, availability of banks, lawyers and accountants, central telecommunication facilities, data processing facilities, condition and quality of entrance, lobby, elevator, and common hallways, security, parking facilities for clients and employees. In case of retail building, identification of major traffic routes and patterns, pedestrian flows, access to public transportation, frequency of public transportation services, location off and on street parking for population and income levels in the surrounding areas, adequacy of parking mix and presence of different retail shops. In the case of industrial premises, access routes for road transportation, distance to railway freight depots, availability of railway spurs, clear height to underside of trusses and beams, dock height, loading bays, load bearing capacity of the floors, adequate turning facility for semi trailers, local transportation, local environment standards, availability of labor pool in the area, industrial waste disposal of hazardous waste. Those are quite important for industrial premises. Now, in case of, so there are also other information required, like such as leasing arrangement. This includes the remaining period on the lease and the rent being paid. Rents are quite straightforward for apartment buildings, but can get complicated for shopping plazas. It's important to spend time and go over the lease to find out what tenant not is paying for and is not paying for. For example, retail store in a shopping center, on the top of the base rent, the tenant might be paying for appropriate share of the common area maintenance expenses as well as percentage of tenants' gross income. Operating and maintenance expenses for subject building, typical operating and maintenance expense for similar buildings in the area, vacancy rates for similar buildings in the area, quality of the management, rental rates for similar building in the area. Now, valuing the commercial properties. For the majority of commercial properties, the three valuation methods can be used: direct comparison approach, cost approach, and income approach. A direct comparison approach, the process and steps involved in valuing a commercial or industrial property using this approach are basically the same as those followed in valuing single property homes and condominium units. The major difference would be in the complexity of a commercial or industrial property as compared to a single family home or a condominium unit. This complexity results in some of the adjustments being very different than in the residential home. When using direct comparison approach for commercial properties, the selling price of the comparables would normally be broken down into one or two of the following units of comparison: price per unit per square foot per meter, price per front foot per meter, price per suite, and price per unit. The decision as to which unit of comparison to use will depend on the type of property and action of typical buyers and sellers in a specific marketplace. For example, if a subject property is an apartment building with 23 bedroom units, it's approximately about 200 square meters in size. A comparable apartment building which is sold for 1.2 million um, might have 25 three bedroom units and approximately 500 square meters in size. The property is very similar in condition and location of the subject property. Based on the price per suite and price per square meters of the comparable are calculated as follows. Price per suite will be 1.2 divided by 25 will be 48,000 per suite. Price per square meter will be 480 square meter. Value of the subject property using price per suite will be 960. Using square meter 960. Clearly the value of the property is 960. In order to use the method, the comparable property need to be comparable. You would not compare 120 unit to the 12,000 square meter with the subject property addition. Adjustment would need to be made to the prices per suite or prices per square meter of comparable properties if there were significant differences in the warranty adjustments. Cost approach. The process and steps involved in valuing a commercial or industrial property using this in the cost approach are basically the same as using single family homes. Commercial and industrial property typically have more detailed calculation concerning the production and replacement cost and depreciation owing to the diversity of improvements, number of mean and ancillary buildings, differing structure heights and grades of construction material, divergent uses within one large complex, and the range of adjustment required for other improvements involving the parking lot, loading docks, mechanical systems, and floor road requirements. Advanced, more detailed methods such as quantity survey methods or unit in place method may be needed for computing replacement cost or reproduction cost new. Income approach. Now, I guess one of the significant challenges in valuing commercial properties arises when dealing with special purpose and single purpose industrial properties, which are often owner occupied. Often, the only approach that can be used with these type of properties is a cost approach. Direct comparison and income approach are not usually viable because of the lack of sales of similar properties and inability to estimate the rental income as a result of the lack of market data. Income approach. For the remainder of this chapter, we'll focus on the income approach, which has not been covered until yet. So, the income approach to the value is based on the income approach to the value is based on the theory that the value of the investment property is the present worth of the future income which this property is capable of producing. This involves capitalization of net income of the property by the appropriate rate into an indication of value. The value of all type of income producing properties is related to one degree to another to the income producing potential of those properties. The higher the potential income, the higher will be the price that the property will command on the market. The appraiser should, however, appreciate that each investor will have his own personal reasons for buying an investment property. While the majority of investors will be interested in achieving the greatest income or capital gains within the confines of generally accepted risk levels, other considerations, for instance, might be prestige, retirement, balancing an investment portfolio for tax savings. However, whatever the reason is for buying an investment property, the amount of money that a purchaser will end up paying will, in one way or another, be based on the income. In other words, there is a relationship between income and value. Steps in the income approach. There are five basic steps in the income approach, and they are as follows: estimate the potential gross income of the property, deduct vacancy and bad debt from the annual gross income to arrive at the effective annual gross income, estimate the total annual operating expenses, deduct the total operating expense from the effective gross income to arrive at the net operating income, use the appropriate method of capitalization, convert net operating income into value. So coming to the step one, estimate the potential annual gross income of the property. The main idea behind estimating potential gross income is the amount of money that a purchaser will probably pay for the investment property based on the rental income that it is capable of producing within the next year or annually in the years following the effective date of appraisal. This estimation of potential gross income is arrived after considering a number of factors, for example, the market rent, 100% occupancy, and typical management. When estimating the market rent of an income producing property, it is the market rent, not the contract rent, that must be used. Market rent is the rental that each unit will most likely command if it were vacant and available for rent on the open market as of the date of the appraisal. Contract rent is the rent that is actually being paid under contract by the tenants of each unit. It is important to keep in mind that the appraiser may have to give consideration to the fact that long-term leases on investment properties and rent control for residential buildings may make it unrealistic to rely on the full market rent. Calculation of the potential annual gross income is based on the total revenue that will be received if all the apartments in the subject building were rented, like it's 100% occupancy. The typical annual gross income of an investment property is based on market rent and on the assumption that there is or will be typically competent and prudent management. An appraiser will start the analysis of the potential income by comparing the owner's last three income statements with those of the comparable property in the area, analyzing the subject property, past and present performance. The appraiser may start the analysis of the income potential of the property by reference to the owner's last three income statements. With these statements may be useful guide. While these statements may be useful guide, they may not be necessarily be a reliable one for appraisal purposes. Some reasons for this could be perhaps the management of the property is unusually poor and current rental as well as are well below what they should be, or rent collection is not efficient and there is an abnormal high ratio of uncollected rents. Analyzing the subject property, past and present performance. The appraiser may start the analysis of the income potential of the property by reference to the owner's last three income statements. While these statements may be a useful guide, they may not necessarily be reliable for the appraisal purposes. Some reasons for this could be perhaps the management of the property is unusually poor and current rental are well below what they should be, rent collection is not efficient, and there is an abnormal high ratio of uncollected rents. Perhaps some of the units have been vacant due to current renovation, the modernization, and the potential income does not show up in the income statement. Perhaps the owner's statement shows income that is not being received. For example, it may include a 1 year lease for $12,000, but in fact the tenant is given free notice of 1 free month, free rent of $1,000. Therefore, the actual rent being received is $11,000 or $12,000 as shown in the statement. Analyzing market comparables. Given this, the estimate of potential annual gross income for investment properties based on the market rather than the contract rent is natural to appraisal to go from looking at the subject past and present performance to the next stage, which is analyzing market comparables. It is from the compared property that the appraiser will be able to estimate the market rent of the subject property. Even though the market rent is objective, in estimating the potential gross income of the property, consideration must also be given to the impact of rent control legislation on the contract term in terms of length of time it would take to achieve the expected market rents. Of course, if the owner's income statement is consistent with the appraiser's analysis, then it's number that can be used in the appraisal work. If not, the appraiser will give more attention to the figures arrived at through his own market research. Step 2. Deduct the estimated vacancy and bad debt from the estimated potential annual gross income to arrive at the effective annual gross income. It should be remembered that the investor purchases as a result An appraiser will be interested in income that the subject is likely to produce rather than it could produce if it was fully occupied and with the tenants paying their rents in full and on time. It's only natural to expect that the property will suffer some income loss and accordingly an allowance for vacancy or bad debt should be made. This allowance is calculated as a percentage of estimated potential annual gross income and will vary according to location, condition, quality of tenants, level of rent of the property as well as the competition and vacancies in the comparable building. Once again, the subject past and present performance is comparable to the vacancy and bad debt being suffered by comparable buildings in the area. If there is a discrepancy, then the appraiser uses his or her judgment with an eye to the market. When the amount allowed for vacancy and bad debt is subtracted from the potential gross income, the resulting amount is known as effective gross income. Estimate the total annual operating income. Net income is used by appraiser in estimating the value of the investment property. Net income is arrived at by subtracting the total annual operating expense from the effective gross income. In arriving at an estimated total annual operating expense, the following guidelines should be used. Include only the expenses that are necessary to maintain the flow of rental income estimated at, as of the date of appraisal. The nature and the level of expenses should be based on the typical management and should be consistent with the market expenses. Since some expenses are concentrated in one particular year and not in others, it is important to stabilize or smooth out the expenses on an annual basis. In estimating the operating expenses, the appraiser should look at the minimum of 3 years operating expense to the owner's income and expense statements and compare them to the information taken from comparable properties in the area and publish studies. If the subject annual operating expenses are consistent with the figures taken from the comparable properties and or published studies, the appraiser can use them in his estimate of operating expenses. There are, however, a number of reasons why the appraiser will normally end up with an estimated operating statement, expense statement that has a different number than those found in the owner statement. For example, the owner of the apartment building usually records expense on a cash basis, whereas you need to look at the expense on the basis of when they were incurred. If the seller pays none of the bills that year, it does not mean that there was no expense. The building may not have computer management and therefore the expenses may not be typical as a result. The owner's statement may include expenses that are not necessary to maintain the current income flow of the building. Examples of this might be capital expenditure, mortgage payment, depreciation, charitable donation, car allowances, business taxes, reserves for capital expenditure. None of these expenses are necessary to keep the capital flow of income going. A tenant will pay the same rent whether there is a mortgage on the property or whether the owner leases a car. Painting of the wall, replacing the walls, replacing the broken window, installing all windows, replacing all the walls, capital expenditure. Installing all the windows is a capital expenditure. Replacing the carpet is a capital expenditure. Replacing the thermostat on a furnace is maintenance. Replacing the furnace with a new one is a capital expenditure. The only time the appraiser may be justified in including the reserve for replacement of such short-term life component operating expenses when the market indicates that it's not practice or by the property owners in the area and the overall capitalization rate used by the appraiser and capitalizing the resulting net income has been extracted from the comparable property study in the same way. Legitimate expenses can occur in some years and not in the others. They may be reasons excluding it from the income. Source income that should be included. Typically, of this would be management fees. Even if owners of the apartment building have been managing themselves, a management fee should be included as time is money. If there is a superintendent that employs the use of a free apartment, the expected rental on that apartment should be included in the gross potential annual income and then shown as an expense. So in this case, the owner's 3 years operating statement would include the rent collection, parking and ordinary income, total income, expenses for realty tax, maintenance, salary, janitor, water, electricity, fuel, insurance, maintenance and repair, painting and decoration, supplies, legal and audit, elevator maintenance, depreciation, mortgage payment, total expenses, and then you get the net income. Step 4 will deduct the total annual operating expense from the effective gross income to arrive at the net operating income. Uses the appropriate method for capitalization to convert the net operating income to value. Capitalization is the process of converting the income of the property into capital value. A capitalization rate So capitalization is the process of converting the income of a property into a capital value. A capitalization rate expresses the mathematical relationship between the income and the capital value of the income producing property. Once the rate has been selected, a method has to be used in order to combine this rate with a defined income. Two basic the two basic methods of capitalization are the direct method and the yield method. The direct method is the most frequently associated with the smaller income investment properties. The yield capitalization method applies more commonly to large investment grade commercial projects and properties. We shall focus on the direct method in our continuing look at the apartment buildings as our commercial property. The two common rates used in the direct method of capitalization is gross income multiplier and overall capitalization rate. Gross income multiplier. The gross income multiplier expresses relationship between the effective annual gross income and the selling price of the property. It should be stressed that the rate is not expressed as a percentage but as a multiplier. So gross income multiplier is the sale price divided by the effective gross income. The first step is to calculating the gross income multiplier. Select the number of comparables from which the sufficient information can be obtained. The compared property chosen must be just that, comparable. They should be similar in terms of the size, utility, price, location, financing, and expense ratios and rents. The appraiser should also look at the gross rent of the comparables to ensure that they have been received on the same basis as subject. In other words, the subject rent includes hydro, heat, parking, and appliances, so should the comparable rents. If this is not the case, the relationship between effective gross income and sale price of the comparable cannot be used directly on the subject's effective gross income without some sort of adjustment. The income figure ultimately used in the calculation for estimating the gross income multiplier from the comparables is based on the appraisal reconstructed statement of those comparables in much the same way as done to estimate the subject's income. So, for example, such a property has effective gross income of $100,000. The comparable sale with the effective gross income of $100,000 is located. The comparable sold for $75,000. So the gross income multiplier would be sale price $75,000 minus the gross income is 7. So the same value the same gross income multiplier can be used here. So gross income multiplier into effective gross income is equal to 700K, which is the value of the subject. In many instances, buyers of relatively small commercial properties will come up with the value of by using GIM, since it's easy to understand, effective and calculate and apply. In addition, the the relevant information is relatively easily obtained. However, this method does not take into account variation in the expenses or mortgage financing and is considered to be mainly a rule of thumb calculation. Overall capitalization rate is expresses the relationship between the current year's income and the value of the property. Overall capitalization rate is calculated. It's combined with net operating income to arrive at the capital value for the whole. The property is the gross net operating income divided the overall capitalization rate. In this course, we shall look at the overall by calculating the overall capitalization rate through the user comparables using the following formula. Once again, it should be stressed that the comparable should be just that, comparable in terms of income and expenses. So to recollect, the collection and analysis of information for commercial properties will likely be more complex and time consuming than it is for a single family homes or condominium. In many instances, the income approach is the prime method for estimating the value of the commercial property. With special purpose or single purpose building, cost approach may be the only method of estimating value. The five steps in income approach: the appraiser need to reconstruct the income and expenses in a statement of all the owners of both subject and the comparable property sales. In the direct method of capitalization, gross income multiplier and overall capitalization rate are used to calculate the direct method of capitalization. With this, we are done with chapter 10. Um, Other property types, commercial properties, for the principle of appraisals. Thanks for your time.